Hello and welcome back to Principles of Accounting 2. I am your host, Dr. B. Happy to have you all with us again. We are in the sixth week of an 8-week course here at UDC's Community College for the fall 2022 semester. Semester's almost over, so we're almost there. Next Tuesday is our last lecture that we'll have together, and then the following week you'll have your final exam. So the time is going by very fast. Today we're going to talk about responsibility accounting, performance measurement, and we'll also have another conversation after this one. And I just want to quickly remind you where we are in the class. We're in week 6. Within week 6, you'll have chapters 24 and 25 homework assignments. Those will both be due on Sunday night. Also, if for whatever reason you may have fallen behind last week, not to worry. I would strongly encourage you to please get caught up as quickly as you can, because I don't want to see you fall behind, especially toward the end of the course, because it does get a little bit busy for you and your other courses, yeah? So please do your absolute best to get caught up. That's really the gist of that part. So. As always, I'll try to make things as relatable as possible and make them as entertaining as I can, so that way everything is understandable. And please feel free to unmute your mic and ask questions along the way. I am here for you all the time, as you know. So when we talk about responsibility accounting, as we get into the conversation, I want you to think about management. Management is responsible for their individual management areas. And what I want you to think about management is responsibilities a manager has for their department. Like a department store. A department store has multiple departments. That's why they call it a department store. For example, Macy's has men's clothing, women's clothing, children's clothing, jewelry department. They might have a home goods department, etc. Those are all individual departments. Each department has a department manager. That department manager is responsible for managing their individual departments. They're responsible for managing their individual departments. What that means is that they're responsible for the sales of their department and the cost associated with running their department. So when we talk about responsibility accounting, I want you to understand that the department manager is responsible for the department sales and for the department expenses. So get into that mindset when you hear responsibility accounting. Think the manager is responsible for their department. I'll show you how it all ties together. Managers are responsible for their individual departments, and they're evaluated based off of their performance managing that department. The department manager gets evaluated on their ability to control costs, generate a profit through sales, and how well they are using their fixed assets, property, plant, and equipment within their department. So the way to think about this is a department store that has multiple departments, okay? We could think of we'll say a hardware store. A hardware store has multiple departments. Think of like Ace Hardware or Lowe's or Home Depot, whatever. They have departments within their store. They have the tool department, they have the lumber department, they got the etc. department, right? Each department has a department manager who is responsible for managing that department. They're evaluated on the ability to control costs, generate a profit, and how well they're utilizing their fixed assets. This concept is called decentralized. It's decentralized because the department managers have the ability to make decisions on behalf of top management. The department manager, they have the ability to make decisions on controlling costs. Sometimes they have the ability to set prices. Sometimes they have the ability to decide how to use their fixed assets to generate income. And so a department manager is, their performance is evaluated on their ability to control costs, generate profit, and use fixed assets. We call these different metrics centers. The department manager is evaluated on their ability to control costs by looking at what we call the cost center. Cost center, the word center simply means a grouping, okay, of like things. That's what a center is. Cost center is a grouping of controllable costs. And the department manager is evaluated on their ability to control costs, things within their control. For example, a department manager would be evaluated on their ability to control labor costs within their department. In other words, the department manager might be evaluated on the ability to control hourly labor in their department. Send employees home early if there's not a lot of customers in the store in order to control labor costs in their department. For anyone who's ever worked in retail, including myself, I've been sent home early, and sometimes you ask your manager, well, why did you send me home early? Well, they have to control their labor costs in their department. And if there's not a whole lot of customers in the store, there's not much you can do, right? So that's why you might get sent home early as an hourly employee in retail. Especially on slow days like, Mondays, Tuesdays, Wednesdays. Now that we're in the holiday season, starting off the holiday season, you'll notice in the retail stores, they got every person available working, right? So their labor costs will be a little bit higher during the holiday season. However, department managers will also be evaluated on their ability to generate revenue. We call this the profit center. The profit center, the manager is evaluated on their ability to generate revenue. Higher revenue, we also expect higher costs. But these things can be managed. And so we evaluate the manager's performance on their ability to control costs, generate a profit, and use available fixed assets. Using available fixed assets, we call that the investment center. The investment center is typically not in the control of a department manager. That's typically in the control of the store manager or top level management. Because department managers do not have the ability to purchase property, plant, and equipment. The store managers or top level managers do. And so we can evaluate the department manager's performance of using the assets, but not with respect to acquiring those assets. Well, we'll talk a little bit more about that here in a little bit. Earlier, I had mentioned that we evaluate the department manager's performance on their ability to control costs. There are two types of costs within a department. We have controllable costs and uncontrollable costs. Controllable costs are the costs that the manager has the ability to control, such as hourly wages of the employees that work within that department. That's a controllable cost. As a department manager, I can control my employees that work for me in my department. I can also control the supplies used in my department. I can control a lot of things within my department. I cannot control things outside of my department. Controllable costs, things that I can control within my department. Uncontrollable costs are costs that I cannot control outside of my department. As a department manager, I can manage my hourly employees. I cannot manage the store manager's salary. or I can't manage my own salary. The store manager manages me. I manage my employees. An uncontrollable cost are costs outside of the department manager's control, such as the manager's own salary. They can't manage their own salary. That gets set by top level management. I also, as a department manager, I also cannot control the cost of utilities. I can't shut the lights off for the whole darn store. Okay. I also can't control the cost of rent for my department. It's not something that the department manager can set. That all that's done at the store level. Yeah, at the top level management. Controllable costs within the realm of the department manager. They can control. Uncontrollable costs outside of the department manager's purview. As a responsible department manager, I can be evaluated on my performance and my ability to manage within my department. Controllable costs for revenue, for controllable costs. Those are the things I get evaluated on as a responsible manager. Responsibility accounting is the ability to use accounting information to evaluate a department manager's performance on controlling costs, and the ability to evaluate the performance based on their individual responsibilities as a manager. Here we see an example of a very large organization. We can say this is, let's get an example here first. Let's say this is Macy's. Okay. Wait, no. Let's say this is Starbucks. This is Starbucks, okay? So Starbucks, we got the board of directors at the very top. The board of directors tells the CEO, president and CEO of Starbucks what to do. Okay. Board of directors hires and fires the CEO. So board of directors is at the very top level. Well, technically above the board of directors are the shareholders. Shareholders are at the top of any publicly traded organization. Then we have the board of directors. The board of directors are selected by the shareholders. They vote on the board of directors. Board of directors gives direction to this president and CEO on how to run the company. The president and CEO tell the vice presidents how to run their individual areas of responsibility. For example, with Starbucks, we have a vice president for Europe, a vice president for the United States, and a vice president for Asia. And those vice presidents have regional vice presidents underneath them. Vice President for Europe, they might have Eastern Europe and Western Europe. For the USA, they have Western Division and Eastern Division. For Asia, they might have Eastern Asia, Western Asia, something like that. And then within those regions, we have regional managers, vice presidents of regions. And then within those regions, we have department managers. Food and beverage departments, and service departments. Then within there, underneath there, we have store level managers and, et cetera, et cetera. But this is a very large organization. We notice that the responsibility lives within each level of management. Okay, board of directors is responsible for the CEO. The CEO is responsible for the entire company with respect to the different regions, divisions. Within the divisions, they're responsible for the regions. Within the regions, they're responsible for the individual management. Within the individual management, they're responsible at the store levels, et cetera, et cetera. We see that responsibility is controllable within each level of management. Within large organizations, each level might see a different level of detail when it comes to revenue and expenses. For example, a department store, our Macy's, for example. Macy's, we have all of our different departments: men's clothing, women's clothing, jewelry, home goods, etc. Department managers receive very detailed reports. For example, a long time ago, when I was a department store manager for Sears, I used to manage the electronics department, real long time ago. Okay, we're talking well over 20 years. Long time ago. I didn't last very long there. But I used to be a department store manager for Sears, managing the electronics department. It was a very long time ago, by the way. And back then, I would receive detailed reports once a month. And these monthly reports would tell me what my inventory levels were, how well each product sold, what my labor cost was. It would tell me things like my individual department costs for various things. Very detailed. Okay, I could tell you what the turnover ratios were for every single piece of inventory in my department based off of this report. Very detailed report. The store manager, Sears, oversaw a lot of different departments. It wasn't just electronics. That was me. I saw the detailed report for electronics. The store manager, they didn't see the detail. They don't care about the detail. They see a summarized version of what I see. So instead of all of the line items representing all of the different sales and expenses, they only see the summary. They see total sales, total expenses, not all the detail within it. And the store manager sees that for all of the departments, just the high level, right? Total sales, total expenses. They don't see every single item, right? So the way to think about it is the person who is closest to the customer sees the greatest level of detail. The person furthest from the customer sees the least amount of detail. closer to the customer you are, the more detail you see. The further away from the customer you are, the less detail you see. That's what I'm trying to get at. Looking at our Starbucks example, we can see at the very bottom, the plant manager. This is one of the closest people to the customer. We can see a lot of detail. Yeah. Then one department, the beverage department, the plant manager can see direct materials, direct labor, factory overhead for the beverage department. This is very detailed information, right? And this is a variance report that we're looking at, and we can see the actual compared to the budget and our variance. It looks like we have $300 unfavorable total variance for controllable costs for the beverage department. So the plant manager, which is the closest to the customer, sees the greatest level of detail. That information gets translated to upper level management as a single line item. Beverage department. That's all they see. They see the totals. They don't see the granular. They don't see materials, labor, overhead. All they see is beverage department, actual compared to budgeted. That middle section here of the variance report. You see the beverage department, budgeted amount, actual amount, and then the variance, $300 unfavorable variance. That vice president, the upper level management there, that vice president of the Western Division for the beverage, for the whole Western Division, they see different level of detail, right? They see salaries for department managers, depreciation expense, insurance expense, and then the individual departments. That's interesting because they see, for the Western Division, the level of detail. They have totals for their budgeted, actual, and variance. Then look at the top level of management. The executive VP for the country. They see, no surprise here, the company's U.S. operations, salaries, quality control costs, office costs, the Western and Eastern divisions, and then their totals. So this kind of shows you, that the greatest level of detail can be seen with the person that's closest to the customer, in this case, the plant manager. The least amount of detail is at the top levels of management. And that's what I'm trying to show you here with this variance report. Earlier I had mentioned that the department manager is responsible for managing costs that are controllable. There are controllable costs and uncontrollable costs. Controllable costs are the costs within the manager's purview. Uncontrollable costs are costs outside of the manager's purview. We can identify controllable and uncontrollable costs by looking at direct and indirect expenses. Direct expenses are costs that we can directly trace to an individual department. And that department manager is responsible for controlling those costs. Indirect expenses are costs that cannot directly be traced to an individual department. These are what we call joint costs. They benefit the department, but not entirely. Let's look at a couple of examples here. Wages and salaries. Wages and salaries can be both direct and indirect. Direct wages and salaries would be the hourly employees working within that department. Indirect wages and salaries would be the department manager's salary or the store manager's salary, I should say. Rent. Rent expense is also direct and indirect. The direct expense is the square footage of the department. Indirect expense is the rent amount, entire rent amount. Utilities. This is indirect. I cannot trace the cost of utilities directly to a department. However, I can indirectly trace it to the department by taking this total utility amount and divide it by the amount of square feet for that department. Advertising, indirect expense. Very difficult to tie advertising to a department. The way we do it indirectly is through the percentage of total sales. Depreciation, definitely indirect expense. I cannot directly trace it to the department. However, I can allocate some to the department by using the hours used of individual assets. So how do I allocate indirect expenses to a department? One of the methods that we use by taking the total cost, multiply that by the percentage of the allocation base used. Oh, I know that sounds complex. It's not. I promise it's easy. The allocation base used is helps to approximate the relative benefit that the department receives. Total cost times square footage of the department. Total cost times hours used. Total cost times, etc. It's the percentage used by that department, basically. Or we'll roll through some examples. I mentioned that some wages can be directly traced to the department, the hourly wages of the employees working within that department. Some wages cannot be. The store manager's salary. Okay. So if we look at the store manager's salary, it's an indirect expense. But I can trace some of that to each department. And I do that by the salary divided by the hours worked. Rent. I can allocate rent to all of the departments. I take the total square footage of the store. Sorry. I take the total rent amount and I divide that by the square foot of the department. Utilities. The total utilities divided by the square foot of the department, and I multiply that by so it's the total size basically. That's how we allocate. Advertising. It's the amount of the advertising times the percentage of total sales. But we can see those indirect expenses are allocated. The service departments. I can allocate service departments to each department as well, indirectly. Service departments are departments that support the operation. Human resources, payroll, office. These are people that don't work for the department, they work for the store. They're what we call support staff or support departments. And those support departments, they're shared by all departments within the store. So I can allocate those expenses to each department based on the common allocation base. For example, office expenses. Take the number of employees, the amount of sales in each department. Personnel expenses, number of employees in each department. Payroll expenses, number of employees in each department. Purchasing costs, dollar amount or number of purchase orders. Maintenance expense, square foot. These are the allocations. Let's walk through an example together. I like this example. This is a jewelry store. Oh, how cute. That place is going to be real busy, I think, on Friday. Right? Okay, here we got a jewelry store. The jewelry store has 3 departments. The jewelry department, a watch repair department. They also sell china and silver. So there's a china and silver department. Jewelry store, very big store. It's 4,000 square feet in total size. Wow, it's a big store for jewelry. So the jewelry store received a bill for janitorial services. The bill is $800 per month. Clean the store. It's just one bill. They don't break it out by department for you. It's just one bill. It's $800 for the whole store. Clean the whole store. They wipe down all the glass and all the display cases. They vacuum. They, do whatever. So management has to allocate the $800 bill to each department in order to understand controllable costs for each department. Right? Let's take a look. This is how it works. We take the square foot of each department. We make that the allocation base. Okay? Square foot of each department is the allocation base. The whole store is 4,000 square feet. The jewelry department is 2,400 square feet. Watch repairs 600, and the china and silver department is 1,000 square feet. We can express this as a percentage of total square feet. The way we do that is we take the square foot of the department and divide that by the total square feet of the store. 2,400 divided by 4,000 is 60% of the total square foot of the store. Repair is 600 divided by 4,000, that's 15%. And china and silver is 1,000 divided by 4,000, that's 25% of the total square foot of the store. Add all 3 departments together, you should get 100%. Now, what we do, now that we have our allocations, take the total bill and multiply that by each allocation. The bill's $800. I multiply that by 60% for the jewelry department. That gives me $480 allocated to jewelry. 800 times 15%, that's 120. 800 times 25%, that's 200. Now what we've done is we've allocated the total cost of janitorial services to each department based on their total square footage. Make sense? Pretty doing all right so far, right?
Yeah, I'm following.
Okay, thank you, Tia. Appreciate that. All right. Let's take a look at a department level income statement and contribution report. just like a store level does, like for the entire store, we can prepare an income statement for each individual department. Got our sales, and when we have all of our cost of goods sold, then we have all of our expenses. In addition to those revenue and direct expenses, I also need to allocate the indirect expenses from service and operating departments to the individual departments. Just like the example I just showed you. So we'll allocate service and indirect expenses to the individual departments. And that will help us to prepare an income statement for the department. So let's take a look at this example. The hardware store example. Got my hardware, housewares, and appliances. These are my three departments within my store. Hardware, housewares, and appliances are my three departments within my store. We call these operating departments. Operating departments, as you would expect, generate sales and direct expenses. For example, the hardware department generated $119,500 in sales for the month. The year, I guess. Must be a real small store. Say it's for the month. This would be nice. No, it's for the year. It's for the year. So hardware generated $119,500 in sales. It's a real small store. We have cost of goods sold, $73,800. Salaries for that department of $15,600. Depreciation for the equipment used by that department, $400, and supplies used by that department, $300. Those are all my sales and direct expenses allocated to hardware. I do the same thing for housewares and appliances, sales and then direct expenses. Remember, direct expenses are the expenses I can directly trace to the department. You'll also notice I have other departments. We call these service departments. These are the support departments for the store. The general office, which takes care of things like accounting, payroll, shipping, other office things, administrative things, yeah. And I also have purchasing. Within general office, I also have like the store manager's salary, etc. So general office and purchasing departments are my service departments. These support operating departments. So within there, I have salaries, depreciation, supplies for general office, and I also have the same for purchasing. Then, in addition to those things, I also have listed out in my expenses rent, utilities, advertising, and insurance expenses, the whole store. So step one is we've allocated sales and direct expenses for each operating department in the store. We've done the same for the service departments, and we've listed out all of our indirect expenses. Step 2 and 3 is that we need to allocate the support departments and the indirect expenses to the departments. Here's how it works. I already have my direct expenses that we just saw. What I need to do is allocate rent expense, utilities expense, advertising expense, and insurance expense to all of the departments. office, purchasing, hardware, housewares, and appliance departments. Here's how it works. For rent expense, it's the amount of space, also known as the square footage. So take the square footage, which is the store square footage. Within the store, I have the square footage for all of my individual departments. Take the total rent expense, divide that by the total square footage of the store, and then multiply that amount by the square footage for each department to allocate the $12,000 in rent. General office got 600 of it, purchasing got 600 of it, hardware department is my largest department, 4,860, 3,240 went to housewares, 2,700 went to appliances. I do the same thing for utilities, also based off of square footage. Total expense was 2,400, and I allocate based off the square footage to each department. You'll notice with advertising expense, it's based off of sales, the allocation base. Because it's based off of sales, the support departments don't have any expense allocated. That's because the support departments don't generate sales. Office department and purchasing department, those don't generate sales. Only the operating departments do. Hardware, housewares, and appliances in this example. We allocate the 1,000 based off of the sales from each department. Insurance expense, the whole store gets insured, so everyone gets an allocation of that. It's based off of the value of insured assets in this example. And then,
Professor,
what? Asia, please.
not to speed you up or anything, but I just wanted to make sure I don't miss the part when we go over the general office department and the sales and how that's allocated.
Yeah, that's almost to where we are.
Okay.
That's where we're just about to get to that part.
Okay.
So step 2 is for the indirect expense allocation, which we just did. Okay. We total up all of our department expenses. What's general, purchasing, hardware, housewares, and appliances. For the general office department and the purchasing department, because these are support departments, we need to allocate those to the operating departments, hardware, housewares, and appliances. That's where this red line you see with the arrows toward the bottom comes into play. The general office department is allocated to the individual operating departments based on total sales. So the way it works is we take the total general office department expenses and we distribute based on sales, percentage of sales, right? Based off that percentage of sales, we take that 15,300 that came from the general office department and distribute that to hardware, housewares, and appliances. So if we look at previous slide, hardware, 119,500. That was the sales for the hardware department. The sales is the allocation base. We take the general office department times the percentage of sales from the hardware department to get the allocation. Does that make sense? That's kind of answers your question, yes?
Yeah, I'm just trying to round it all up. So the sales from the I'm sorry for the background. Oh my gosh.
Oh, you're good.
Okay, so the sales total from the previous slide, the I think 119 and
Yeah,
whatnot, is that for a month of sales or
it's for the year.
it's for the year? Okay, that's why. Okay,
So
okay,
one
that's
nineteen
why you're
five.
taking the whole. Mm-hmm.
No, you're fine. It's okay. So 119 5,000 plus 71,700. 19, sorry, 500 plus 71,700 plus 47,800. This is a total amount of sales of 239,000. So if I take 119,500 divided by my 239,000, that gives me 50% of all my sales comes from hardware. If 50% of all my sales comes from hardware, I take 50% of 15,300 to get 7,650. So take total sales, hardware department plus housewares department plus appliances department. Total sales, 239,000. Take the department sales divided by the total sales to get the percentage of total sales for each department. Okay. Once you have the percentage of total sales for each department, you take the total expense for the support departments, in this example, 15,300, times 50% allocation to hardware to get 7,650. Housewares, you take 71,700 in sales divided by 239,000, get the percentage for housewares. 71,700 divided by 239,000 is 30%. So if we take 30% times 15,300, we get 4,590. So we see where we're going. 50, 60, 70, 80, which means 20% gets allocated to appliances. So 15,300 times 20%, 0.2, is $3,060. You take that same application for the purchasing department. 50% times 9,700, that's 3,880. 30% times 9,700, that's 2,630. 20% times 9,700, that's 3,190. That's how we allocate the general office department, purchasing department to the individual operating departments. Everyone clear on how that works? Any questions? Are we good? Yes, no, maybe? You may have stepped away. Everyone understands how we got there, though, right? We took the support departments and applied the expenses from those departments to the operating departments. Yes, hello? Am I the only one here?
No, I'm here, Professor.
Yeah, yes, I understand.
Okay, all right, cool. Awesome, thank you all. You all understand why we do this, right? The reason why we do this is because we need to be able to generate an income statement for each operating department. And the only way you can do that is by allocating all of the indirect expenses to the operating departments. And that's how we do it. Okay, cool. So now that we've done that, we can generate the income statements for our 3 operating departments: hardware, housewares, and appliances. And we can generate, for each department, looking at sales minus cost of goods sold equals gross profit minus your operating expenses equals your total operating expenses equals gross profit minus your total operating expenses equals net income. In this case, operating income. We can see where the allocations happen. Direct expenses, those are your hourly employees, the expenses used by the individual departments that are traceable, your direct expenses. Your allocated indirect expenses came from your support departments and your other expenses: rent expense, utilities, advertising, insurance, and then the support department's general office and purchasing. This is how we formulate individual income statements for each department. Now that we've done that, we can actually figure out the contribution margins for each department. How much revenue am I generating, or how much profit am I generating from each department? I take the total department revenue, sales, minus the direct expenses equal the department contribution overhead. Department contribution, we use this to evaluate the manager's performance of the department. Sadly, I can use, if it's negative, the revenues aren't covering the direct expenses for whatever reason, I can use that information to potentially eliminate a department. Sales minus cost of goods sold equals gross profit minus your direct expenses gives you the department contributions to overhead. Of these 3 departments, we can see the application. After I've done the contribution, I will then look at my indirect expenses and how they're applied. Then I can make a decision if I need to eliminate a department. In this example, I might look at appliances a little bit closer. Reason? Because the department contribution for appliances is relatively low. We can use this that information to, evaluate the health of the company. I also look at how well I'm using my fixed assets to generate revenue for each department. We called that the investment center, remember? Investment center helps to evaluate managers' performance using their ability to generate revenue using the fixed assets of the company. To measure their ability to do that, we look at things like the return on investment, ROI, residual income, profit margin, and inventory turnover or investment turnover. As you know, these are ratios, right? We've calculated most of these already before, but these ratios we use in the investment center to evaluate the manager's performance. Return on investment, we look at the investment center income divided by the investment center average invested assets. That's a mouthful. We take the income divided by average invested assets to get the return on investment. And I can do that for each department. Investment center residual income. We take the net income of the investment center minus the target net income. Investment center income minus the target net income gives us the investment center residual income. For the profit margin, we take the investment center income divided by investment center sales. We find profit margin. We'll know that. We've done that so many times. For investment turnover, we take sales divided by average assets. Find the total return on the investment, we take profit margin times investment turnover. Balanced scorecard. Oh, so important, balanced scorecard. I think we talked about this briefly before, but the balanced scorecard is another metric that we use in order to evaluate the performance of a manager. The balanced scorecard contains both financial performance and non-financial performance. Financial performance, as you know, looking at things like the income statement, balance sheet, statement of cash flows, sales amounts, etc. Okay, the amount you're spending, etc. Those are quantitative pieces of information that we use to evaluate the manager's performance on a balanced scorecard. The non-financial pieces of information include things like customer satisfaction rating, employee satisfaction, employee turnover, the defect rate, etc. So as you can see, the balanced scorecard is a combination of both financial and non-financial information used to evaluate the performance of the manager and ultimately the company. For information, we look at things like satisfaction, number of new customers, percent of on-time deliveries, sales of new products, time to fill order, percentage of sales returned, etc. There's a lot more than that, but that's just a small list of it. For internal processes, the defect rate, cycle time, product costs, labor hours, so forth and so on. For research and development, also known as innovation and learning, we look at things like employee satisfaction, employee turnovers, a dollar amount spent on training, number of new products, number of new patents, and dollar amount spent on research. And the financial indicators, we look at net income, return on investment, sales growth, cash flows, residual income, stock price, etc. All of those things together make up what we call the balanced scorecard. It's financial and non-financial information used to evaluate the performance of a manager and ultimately the company. For larger companies, they might be faced with a situation where they have to transfer products from one location to another. We call these transfer pricing and transfer prices. Transfer pricing is the amount that we charge when a division sells goods or services to another division. I'm moving sales or inventory from one department to another. moving inventory from one department to another. When you do that, there's a cost associated with that, right? For example, Macy's. Macy's on the East Coast, we got plenty of inventory, so we need to ship some inventory to Macy's on the West Coast. To do that, there's a price associated with doing that. There's a cost. And that cost is called transfer pricing. Cost of transferring it from one department to another. We get a couple of items before we make a transfer. Capacity to have it here on the East Coast, sales price, variable cost of manufacturing the product, the fixed cost of manufacturing. Those pieces of information help us to determine the transfer price. Just so you know, the transfer price is typically somewhere between the sales price and the variable cost. A couple of formulas you need to know. The cash conversion cycle. The cash conversion cycle helps us to measure the amount of time it takes to convert cash outflows into cash inflows from customers. Fancy way of saying how quickly I can collect cash from my customers. That's the cash conversion cycle, how quickly I can collect cash from my customers. To find that, we take day sales in accounts receivable plus day sales in inventory minus day sales in accounts payable. Each one of those things is its own formula. Oh, I know, it's so complex. Just do it in steps. Just like everything else you've learned in accounting so far, everything is done in steps. First, we find day sales and receivables. Total accounts receivable divided by net sales times 365 days. Then we find day sales and inventory. Total inventory divided by cost of goods sold times 365 days. Very simple. Days in accounts payable. Total accounts payable divided by cost of goods sold times 365 days. Day sales and receivable plus day sales and inventory minus day sales and accounts payable gives us our cash conversion cycle. It's a complex formula, but as long as you do it in the steps, you'll be able to figure it out. Here's an example of that. Example thing. Cost allocations. When we allocate cost, just like I showed you how to do it with the example with the jewelry store, allocating the cleaning bill, you take the total cost to allocate, and that example is $800, times the percentage of the base used. Percentage of the base used is a percentage square foot for each department. In that example. Our hardware store, we used a couple of different allocation bases. We used square footage of floor space, dollar of insured assets for the insurance expense, sales dollars, and the number of purchase orders. So different allocations, but for the same reason, to allocate indirect expenses to the departments. Same concept with rent, right? We take the percentage of square footage for each department, take the total rent amount times the percentage of square footage for each department to find the allocated cost. For utilities, also based off of square footage for each department times the percentage of square feet to equal the allocation of the cost for utilities. For advertising, it's based off of sales dollars. You can only allocate sales-related expenses like advertising to the operating departments that generate sales. For insurance, I mentioned it was based off of the insurance value as the base. So value of the insured assets times the percentage to get the allocated cost of insurance. For the service departments, office, payroll, etc., reallocated based on sales for each operating department. All we're doing is we're breaking down our earlier example. Yeah. For the service department expenses, again, based off of sales, number of purchase orders in one example. Looking back at our transfer pricing conversation, again, the transfer price will come in between the total sales price and the variable cost per unit. Typically, within a company, it's usually close to the variable cost per unit is the transfer price. This shows the example here. Joint costs. These are costs incurred that are shared across departments or across products. It's just an example of how we would allocate joint costs across different products. It's really very similar concept to what we explored earlier. Okay. Any questions so far on responsibility accounting? Makes sense, right? Any questions at all so far?
So basically, as long as you have the percentages of the department, you should be able to allocate, what that department requires or what is using as far as expenses.
Yeah,
Is
you
that
got it.
okay?
That's exactly right. So looking at our earlier example, how we got those figures, right? The hardware department, 7,650. How we got that? Well, what we did is we took total sales for the entire company. In this case, 239,000. I added hardware plus housewares plus appliances to get $239,000 in total sales. I took each department sales, 119,500, divided by total sales, 239,000, to get 50%. Okay. Once I got the 50%, then I came down and I said, okay, take the total expense for the service department times that 50% sales to allocate the expense to the operating department. So 50% times 15,300 is 7,650. And I use the same approach for housewares, appliances. I took the sales for the department divided by total sales to find the percentage. Take the total expense times the percentage to allocate the service department expense to the operating department. Question. Any other comments, questions, or concerns so far? Okay, let's take a 5-minute break, y'all. I'm going to stop the recording here. and start the next one soon.